Wealth is not built with speed, but with consistency. Warren Buffett. This phrase captures the essence of the financial journey many wish to embark on, but few truly understand. In an era where quick investments, volatile cryptocurrencies, and promises of instant wealth dominate the financial landscape, Buffett's wisdom reminds us of a fundamental principle. The safest path to wealth is paved with patience, discipline, and consistency. But why is it so difficult to adopt this mindset? Because we are constantly bombarded with stories of quick gains. The media glorifies those who got rich overnight, creating the illusion that wealth can be achieved with a single lucky move. However, Buffett's story proves otherwise. He began investing at a young age and accumulated his fortune over decades, not through luck, but through strategic and consistent choices. And here is the secret that few realize. You don't need large sums of money or access to exclusive opportunities to start building wealth. All you need is a solid strategy and the discipline to follow it. Buffett doesn't invest in fads or passing trends. He looks for solid businesses with strong fundamentals and holds these investments for years, sometimes decades. Imagine planting a tree. In the beginning, it seems like nothing is happening. You water it, care for it, but the results aren't immediate. Over time, that small seedling transforms into a robust tree, capable of providing shade, fruit, and shelter. Consistent investing works the same way. In this video, we'll explore how you can apply Buffett's principles to build wealth in a consistent and sustainable way. I'll share practical strategies, inspiring stories, and valuable lessons that can transform the way you invest and think about money. Are you ready to learn how patience and consistency can be your greatest allies in building wealth? Then keep watching, because the next steps could be the turning point in your financial journey. To understand how to build wealth with consistency, we need to dive into the principles that have guided Buffett throughout his career. His success is not the result of luck or flashy investments, but of a solid philosophy grounded in patience, discipline, and long-term focus. Let's break down these principles and see how to apply them in practice. Buffett often says, if you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This mindset highlights the importance of a long-term vision. Many investors fall into the trap of chasing quick profits, buying and selling stocks based on news or market rumors. Buffett does the exact opposite. He invests in companies with solid fundamentals, clear business models, sustainable competitive advantages, and competent management teams. Most importantly, he holds onto these investments for decades. A classic example is his investment in Coca-Cola. Buffett bought shares of the company in the late 1980s and still holds a significant stake today. Coca-Cola not only appreciated over time, but also paid consistent dividends, generating continuous cash flow. Buffett avoids businesses he doesn't fully understand. He has stated, never invest in a business you cannot understand. This principle has kept him away from market bubbles and speculative investments, such as complex tech startups in the early 2000s or cryptocurrencies more recently. He prefers to invest in companies with simple business models, essential products or services, and consistent demand. Companies like Apple, American Express, and Gillette are clear examples of this approach. For you, as an individual investor, this means looking for companies whose products you use or understand well. For instance, if you've been a customer of a bank for years and trust its services, why not study that bank as a potential investment opportunity? Buffett is adamant that the stock market should not be treated like a casino. He avoids following trends and speculation. The dot-com bubble in the late 1990s and the subprime crisis in 2008 showed how speculation can destroy fortunes. While many panicked or followed the crowd, Buffett remained calm and invested strategically. He believes the market is driven by two main emotions, fear and greed. The wisdom lies in being greedy when others are fearful and cautious when others are greedy. An example of this was during the 2008 financial crisis when Buffett invested billions in companies like Goldman Sachs and General Electric, taking advantage of the market's devaluation. Buffett has always reinvested the profits earned from his investments. He understands that compound interest is one of the most powerful forces for building wealth. Berkshire Hathaway, his holding company, rarely pays dividends. Instead, it reinvests profits into new opportunities, continuously increasing the company's value. For individual investors, this means not spending dividends or profits immediately. If you receive dividends from stocks or profits from investment funds, consider reinvesting those earnings to accelerate your wealth growth. Buffett doesn't try to time the market. He makes consistent contributions regardless of economic conditions. Instead of attempting to predict crises or peaks, he focuses on buying good businesses at fair prices and holding those investments. Throughout his career, Buffett has demonstrated that consistency is more powerful than the pursuit of quick results. Small, continuous steps are more effective than sporadic big leaps. These are the initial pillars for building wealth consistently, following Buffett's principles. Now that you understand the importance of adopting a long-term mindset, investing in simple and solid businesses, avoiding speculation, reinvesting profits, and maintaining consistency, it's time to dive deeper into the strategies Buffett uses to identify valuable opportunities and thrive even in times of crisis. Buffett has always emphasized the importance of patience in investing. He once stated, "The stock market is a device for transferring money from the impatient to the patient." While many investors worry about daily fluctuations and seek quick gains, Buffett understands that true wealth growth comes with time. He is in no rush. If he doesn't find an attractive investment opportunity, he prefers to keep the money in cash until a good opportunity arises. A remarkable example of this patience was his investment in Apple. Buffett avoided technology companies for decades because he considered the sector difficult to understand. However, when he realized that Apple had become a well-established consumer company with a loyal customer base and strong management, he invested heavily. Today, Apple is one of Berkshire Hathaway's largest holdings, generating extraordinary returns. Another pillar of Buffett's strategy is the search for undervalued companies. He follows the philosophy of his mentor, Benjamin Graham, known as value investing. The focus is on buying shares of companies being traded at prices below their intrinsic value. To do this, Buffett analyzes factors such as free cash flow, return on equity, profit margin, durable competitive advantage, moat. A classic example of this strategy was the acquisition of American Express in the 1960s. The company faced a market confidence crisis due to a financial scandal, and its shares were trading at low prices. Buffett recognized the value of the brand and the loyalty of its customers, invested in the company, and reaped extraordinary profits over the years. Buffett is a master at turning economic crises into profitable opportunities. He believes that moments of panic are ideal for buying quality assets at a discount. One of his most famous pieces of advice is, "Be fearful when others are greedy, and greedy when others are fearful." During the 2008 crisis, while many investors fled the market, Buffett invested billions in companies like Goldman Sachs and General Electric. He took advantage of the devaluation of these solid companies to acquire strategic stakes under favorable terms. Buffett dedicates a significant portion of his time to reading and studying. He has revealed that he spends about 5 to 6 hours a day reading newspapers, company reports, books, and market studies. For him, accumulated knowledge is a competitive advantage. He states, "The best investment you can make is in yourself." Buffett does not get carried away by trends or external pressures. He follows his strategy with discipline, even when it means going against the tide. His resistance to investing in technology for many years is a clear example of this. He's also disciplined in keeping costs low, both in his holding company and in his acquisitions. For Buffett, costs are invisible enemies that erode returns. Buffett began investing as a child and often speaks about the power of compound interest. He understands that exponential wealth growth occurs when profits are continuously reinvested. If someone invests 100 Rs at a 10% annual return, at the end of 1 year, they will have 110 Rs. In the second year, the return will be on 110 Rs and so on. This exponential growth over decades is what transformed Buffett into one of the richest men in the world. All these principles are part of Buffett's strategy for building wealth in a solid and consistent way. There are no shortcuts, only discipline, patience, and well-founded decisions. However, understanding these concepts is just the beginning. Now it's time to turn these lessons into action and start applying these principles to your own financial journey. After exploring in depth the principles that guide Buffett in his journey to build wealth with consistency, it's time to reflect on how you can apply these teachings to your own financial life. Buffett has shown us that lasting wealth is not the result of luck or quick moves, but of a solid strategy, patience, and unwavering discipline. Imagine how your life could be transformed if you start applying these principles today. 5, 10, or 20 years from now, you could look back and realize that small decisions made with wisdom and consistency completely changed your financial reality. Remember, the best time to start investing was yesterday. The second best time is now. Don't wait for the perfect opportunity. Financial success doesn't come from big leaps, but from consistent steps in the right direction. If you want to build a solid and sustainable financial life, follow Buffett's example. Invest wisely, study constantly, be patient, and stay disciplined. Now it's your turn. Start implementing these steps in your life and watch the transformation unfold. If you enjoyed these lessons and want to learn more about achieving financial success, inspired by great investors, don't forget to like this video and subscribe to the channel. This way, you won't miss any content that can transform your perspective on finances and investments. See you in the next video.